What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are breaking down the new proposal of a 50-year mortgage. Right now, we currently have a 30-year, and President Trump is looking at pushing out a 50-year mortgage. And we'll talk about why, what's the point, is it a good idea, is it a bad idea? And we'll kind of go into the article and kind of talk more about it. So if you were excited for today's video, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. All right. So President Trump has floated the 50-year mortgages as a way of improving housing affordability and bringing new life back to the deeply stuck market, the housing market specifically in this case. And the idea behind a 50-year mortgage and why it makes it more affordable, quote unquote, more affordable, okay, is that think about like a car loan, right? When you go up and you want to go buy a car, you have a 5-year, you can get a 6-year, 7-year, 8-year loan, whatever the case is. If you extend the loan out to a longer time, you get a lower payment monthly, but you pay more in interest, right? That's the gist of it, okay? So with you going from a 30-year mortgage to a 50-year mortgage, yeah, you might have a lower payment because you have a lot more time to pay it back, but you're going to end up paying a lot more in interest. So you have a lower cost to get into a house, but you'll be paying a lot more for it as a result. And we're talking about the math behind it. Don't worry, we got the math here for days to talk about what's going on here. On Saturday, Trump posted a graphic on Truth Social juxtaposing a photo of Franklin Delano Roosevelt, whose New Deal helped lay the groundwork for the 30-year mortgage, and a photo himself with text reading 50-year mortgage. Okay, stupid advertisement for mortgages here. Bill Polt, the director of the Federal Housing Finance Agency, said in a tweet that his office was working on such a mortgage, calling it a complete game changer. I wouldn't go that far, my friend. A complete game changer? I don't know about that. A day later, he added that the agency was also working on ways to give relief in the 5-year mortgage, the 10-year mortgage, and the 15-year mortgage without providing details. So just being like, hey, we're in the works of stuff. Just trust us for now. The appeal of a 50-year mortgage is simple. Home prices are near all-time highs, leaving many aspiring buyers priced out of the market. True. A longer payback period would lower monthly payments and give more people a foothold in the market. Okay, basically what I was just saying earlier, as you extend out your mortgage payments into 50 years, you pay more in interest, but you get a lower monthly payment, so you can get into a house more. Very interesting, that's the pro, but there's cons to it. We'll talk about that. But the extended time horizon also has major downsides. Homeowners will build equity much more slowly and could ultimately end up on the hook for almost double the interest they'd pay compared to a standard 30-year mortgage. Paying more interest because you're going from 30 years to 50 years. Makes sense. Here's some math. Let's break it down. Here we go. Take a buyer of a $415,000 home. Very specific, by the way. Couldn't just do like $400 for myself, but it's okay. Which is around the median price in the U.S. Oh, that's why. Never mind. I gotta read sometimes. If they put 20% down and receive today's average 30-year mortgage of 6.22% over 30 years, they'd pay $2,038 a month in interest and principal. Over the course of 3 decades, that works out to be about $734,000 paid total, with $402 of that going towards interest. Okay. So again, the home is worth $415,000 in 30 years. You're basically paying almost double that because of interest and everything else, right? The compounding effect and everything that we go into it. Obviously, you pay more than $2,000, then you can be able to pay it down a little bit more, obviously. And again, it's not factoring in, you and stuff like that. And, you have taxes every year you got to pay for it and stuff like that. But regardless of that, over 50 years at the same interest rate, their monthly payment would fall to $1,802 a month. Oh, wow, $200 less. But their total payments would rise to $1.08 million and $749 going toward interest. Oh my God. So an extra 20 years, you save $200 a month. Yay. But you pay almost double the interest of a 30-year. But even that gaping difference in a long-term cost fails to account for higher interest rates for longer loans, which is true. And the reason why, and they're going to say it here as well, but I'll explain it in my own words first, and hopefully it'll make sense to you guys, right? But if you're taking out a loan for a longer period, there's more of a risk of a default as at some point in time, right? If you go from a 30-year to a 50-year, you're giving the person who's getting a loan 20 years for something to happen in the economy, in their job, or whatever the case is. They could default on their loan, they could get unemployed, they could be laid off. We could have a housing market crash just like '08, and that was a huge problem, as we know. We could have the Great Depression, which I hope we never have ever happened again. Even though I wasn't around for it, that was crazy to see what was going on there. But with there being more time to pay the loan off, there's more of a chance of defaulting on the loan, which means you are more of a risk because there's more time for you to make a mistake and to not pay it off, and more of a time for something to happen. So you have more risk. When there's more risk, you get a higher loan interest rate. That's how it works, okay? A 50-year mortgage rate and therefore total interest payments would almost certainly be higher compared to a 30-year mortgage to account for the risk that comes with a longer time horizon. Basically what I just said. I probably could have said it just like that and just read it that way, but that was my word of it. And the difference can be large. While 30-year mortgage rates averaged 6.22% last week, rates on the 15-year are about 5.5%. So if you want a lower mortgage rate, what you would have to go is go for a shorter time period also, right? So from a 15 and a 30-year perspective, you're looking at almost a 3/4 of a percent of a difference, which makes a huge difference in the math. If this mortgage is going to dramatically cut down your monthly spend, then you are going to pay for it on the other end. All my math mind thinks about is how bad this is going to have to be for homeowners with the amount of extra interest they will have to pay back, which is absolutely crazy. The savings from the 50-year mortgage may be totally negated by rising home prices. This is not the best way to solve housing affordability. And again, think about this, right? If you're going to end up paying, let's go back to the math here really quick. If you end up paying $1.08 million over 50 years, right? And your house this house hasn't appreciated to 1.08 in 50 years, you're underwater, right? You're down, you're negative. And it would have to go to 1.08 just to break even. You're looking at over doubling your home price, almost 3 times your home price in 50 years for this to happen. Whereas if you're looking at a 30-year, you need just to double in the 30-year, right? Not even double, less than doubling in the 30-year, essentially, right? So that's what they talk about when you're saying like you're getting less equity in it because, again, you're paying $1.08 million into it, but what if the house is valued at $1 million in 50 years? Well, you're down, right? If it's valued at $1 million in 50 years and you were done in 30 years, you're actually up, $300,000 as a result of this investment, right? So that's kind of something to keep in mind about that. Your equity makes a huge difference here, right? You buy a house to build equity, and right now that may not happen as a result of it. So something to kind of really keep in mind about. Ultimately, the best choice for a would-be homeowner comes down to a variety of factors. He counsels his clients who are considering different mortgage options to weigh the opportunity costs of their payments, current and future inflation possibilities, and their liquidity positions when making a decision. Just in case you had to take money out to be able to pay for your house or whatever. So having the money liquid, be able to move it whenever you need to, definitely helps out. It's really a cash flow decision from a household perspective. How much can I afford to pay? The payment program is really different on a 30-year or a 50-year versus a 15-year mortgage, right? So, just things to kind of keep in mind about, an associate. So, Janae Gao, an associate professor in finance at Georgetown, said more choices in financial products are usually good news for consumers who can pick the one that best meets their needs. But a product like a 50-year mortgage that extends beyond most people's working years poses additional risk. Essentially loading the payment burden for your older self. What I think regulators and vendors should be concerned about is households being overly confident about their repayment capabilities, aka, financial education 101, Fridge Financials, dropping all the knowledge, right? So, yes, it's good to have the options, which is what they're saying here, but imagine you're locked in for 50 years. Like if I got a house now, I'm almost 30. I'm 30 in a month, right? December 11th, I'm 30 years old. I would be locked into this mortgage till I'm 80 years old. Like, that's crazy, 80 years old. My house is paid off. Woo, good job, Jay. Good job, right? So I don't really quite know, honestly. I don't agree with this because, you extend out the mortgage. What did you mean? Next is going to be what, a 100-year mortgage? Like, what's the even point of even having that at this point? It's going to just, the people who are going to be making the money from this are the big banks, the loan providers, the financial institutions. Those people are making money because now they're getting a crap ton more interest, locked up for longer. They're locking more people in for it. And it could cause that idea. What if people are getting all these houses and they can afford it, and then if they can't afford it, then what happens, So that is it. Just a very interesting perspective. And the math to me doesn't make sense. I would not do a 50-year mortgage for this reason. Your interest is crazy. The 30 years even crazy enough. But, the 15-year definitely is the best method of it. 30-year, obviously the next best one. 50-year, I don't even know what's going to happen with that one. I would be curious to see if anybody, gets the 50-year mortgage just to get a house. You might as well just keep renting at that point because you're not going to build much equity in those 50 years until, maybe you will. Who knows, obviously. But, there's a lot of math behind it, but it's absolutely crazy. So thank you guys so much for watching today's video. If you did make it this far in the video, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. As always, I hope you're making money in the market in some way, shape, or form, and I will see you guys in the next video.